Large quantities of silver are being transported out from exchange warehouses and sent to secondary silver vaults across the country, ensuring the daily silver needs of millions of industrial enterprises. At the same time, state-owned enterprises are taking advantage of the significant price pullback to actively purchase silver from international markets, ensuring the normal operation of the industrial system. China is intensifying reserves of various strategic resources and will absolutely not allow key mineral resources to flow out of the country, nor will ever compromise national interests to rescue a foreign company. Now, here's another thing. Eric Young, King Kong on Twitter, someone that I've been wanting to have you interview. I've interviewed him once before, and he's fantastic. He was just told, he says, I was just told that a 150-ton lease, or 4.82 million ounces, actually was leased by the London Metals Exchange from the Shanghai Metals market, and that it was done so at grotesquely high lease rates for a very large tonnage. This would signal that borrowers who are short of deliverable metal and are willing to pay up to bridge the near-term needs in London are doing it because things are of that dire of a situation where it could really start to spiral and contagion can take effect. So again, when you see someone at this level who's been right for a very long time, and I have nothing but the highest amount of respect for him, to me, the bottom line is that the theme that we've been talking about, the tight physical, the high lease rates, the cross-region scouring for bars, this is real and well reported. And if you see 150 million tons from Chinese state banks and via the Shanghai Gold Exchange delivered to London to quell this problem, it would go hand in hand with knocking the hell out of the price by the same players to make people think the market is overvalued, that it's at its peak like it was in 1980 and 2011. And look, letting the price go up as high as it did pulled in an awful lot of speculators. And a lot of them didn't own gold, they just owned paper. And so when you dump massive waves of futures contracts into this thinly traded market, a lot of them sold without even knowing. They got triggered out of their contracts, which drove the paper price down. And maybe that's when you had London come in and say, we need to buy this silver at a lower price. Maybe it was London who came in and bought that silver after they knocked it down. I don't know who did it and who bought it, but I do know is that, to me, the whole point was to scare people away from buying gold and silver. That's what it really feels like to me. And this wasn't just another random correction. To me, it's as much as it could be as big as helping keep the LBMA propped up to maintain their system. But if there really is that much of a shortage that we've been hearing about forever, this game can't last, and supplies will keep shrinking no matter what amount of paper selling comes into the market at inopportune hours. And so I think, again, yes, it's scary to see a market move like this, but the fact that it moved like this is what, to me, makes it not so scary. It just reeks of desperation by big players who have been caught in a game where no one ever stood for delivery, and a continual rotation of paper promises has been what has allowed the fixing of gold and silver by the West forever. And it is now being challenged. Not just gold and silver, all of the world's commodities are being bought. And when we see 21 days of backwardation, where the normal market is called contango, where the price is for the future, or the spot contract is lower than the futures contract. When you go out into time, you have the cost of storage and interest and the time value cost of money. That's normal market. Backwardation says, I don't really want to trust you next month or the month after. I want it now, and I'm actually going to pay more for it right here today than I will out into the future, because I really don't trust the future. And to see that in silver is really unusual. And for as long as we did, and as much as $3, now it's narrowed. But what I'm saying is that is really very bullish. And when you see this kind of desperation, knock the hell out of the price and then gobble silver up to where it goes green in 20 minutes, someone came in and bought physical. And maybe that was the trade. Maybe what Eric Young is saying happened right then and there, that China leased the gold at that level, sold the gold, I mean, I think it all boils down to a breakdown in confidence in the dollar, Michelle, as a reliable store of value. It's like a melting ice cube. The trust in the dollar, the trust in things like the Bureau of Labor Statistics or the CFTC. The CFTC, if you ask most people who were watching the JP Morgan trial when they did pay a $920 million fine to the Justice Department for spoofing, that it should have been RICO charges, that it should have been much more severe than it was, that the CFTC hasn't done anything to protect the gold and silver market. Trust in the dollar, trust in our institutions, trust in everything is fueling. This is what has been fueling higher commodity prices, tighter credit spreads. Real assets like gold and silver are stepping in to capture what the dollar and the loss of trust is losing. And I think when trust in the dollar starts to slip, and in our institutions and in our reporting of the facts and of reality, people move into real assets like gold and silver. This isn't about price increase in gold that we've been seeing for the past 9 straight weeks. It's about a revaluation of all fiat currencies by gold. And I think that that's really what is happening. And I think it started to arguably start to make people nervous that things needed to I think calm down a little bit, and people are most affected by price. It is the greatest tool of misdirection. They don't look underneath the hood. They just see the price and they listen to the nonsense media. And shame on all of these media talking head geniuses who, on one hand, from an economic perspective or from a market and analytical perspective, are correct. But ignoring how it was achieved is ignoring the most important part of the story. And I think it renders what they're saying moot.
I'll tell you something straight away. What we're witnessing in the silver and gold markets is not another benign pullback, not a buy the dip moment that ends quietly. It's the beginning of something much bigger. If you ask me where gold is going, I'll be blunt. I'm not sure of the exact number. What I am sure of is where silver can go if gold hits certain trigger points, and I think we're closer than most think. Let's start with gold, because that sets the stage for silver. I've been showing a log-scale chart of gold going back decades, to 1975 when American ownership of gold was legalized again, and even earlier. We've had 2 major bull markets in that span. Both produced roughly an 8-fold increase from their lows to their highs. One ran for about 3 years, the other about 10 years. Now our last major low in gold, around $1,046 in 2015, gives us a base. Multiply that by 8 and you get roughly $8,000 plus. That's not wild guesswork, it's pattern recognition. Here's the kicker. When those prior bull markets happened, the external environment was less extreme than what we see today. Government debt, global monetary expansion, currency debasement, all of it were less profound then than now. So if anything, this time could produce an even larger move. I'm comfortable saying gold will at least see the $8,500 area if the trend plays out as it should. Now turn to silver, and this is where things get exciting. Silver moves with gold, yes, but it also has its own rhythm. Historically, silver has lagged gold in bull markets, then crushed it in the spurt phase. This year, it's actually up more than gold year to date, just by a few digits, but it matters. But here's the part most people miss. Silver is still very cheap compared to gold. Right now, an ounce of silver is about 1.125% of an ounce of gold. Expressed another way, the gold-silver ratio is somewhere near 89 to 1. Historically, silver has traded at 2% or higher of gold's price in 21 of the last 50 years. In big bull phases like 1979 to 80 or 2010 to 11, it hit 3% or more. So at 1.125%, silver's undervalued relative to gold. But even more important is what I watch: the spread momentum between gold and silver. Since April of this year, we've seen that spread begin to turn. It hasn't broken out definitively yet, but if the silver-gold ratio pushes above roughly 1.31%, or equivalently, if silver gains relative strength versus gold, we will be at a classic breakout point. Historically, once that spread flips, silver explodes. In 1979 late summer, the spread broke, and silver went from roughly $20 to $50 in 6 months. In 2010 fall, it broke and went from $28 to $50 by early 2011. the pattern repeats. If gold follows its eightfold pattern and hits approximately $8,000 or more, and silver simply rises to 2% of that, a modest math target, then silver at $160 looks entirely reasonable. If silver ratio hits 3% of gold, it could go to $200 plus given the same gold move. Those are not wild speculations. They're ratio-based projections consistent with prior cycles. A big part of my focus is when this move happens. I'm not saying it happens tomorrow. Timing is never precise. But I am saying we are in the acceleration phase. In past bull markets, the majority of the gains happened in the final 6 to 12 months. The move isn't linear, it's exponential. Once the momentum turns, things happen fast. Half of the entire bull market gain often occurs in a fraction of the time. That's why when you see a setup for silver like this, deep undervaluation, spread break about to happen, fundamentals tight, you lean in. And yes, the fundamentals are tight. Let's talk supply and demand. For silver, supply is structurally constrained because most silver comes as a byproduct of mining other metals: lead, zinc, copper. So even if silver price doubles, supply doesn't necessarily surge. Meanwhile, demand is increasing. Not just monetary demand, investors buying metal, but industrial demand, solar panels, electronics, EV infrastructure. The imbalance is building. So when we're speaking about new reality for silver, this is it. I believe silver is entering the stage where its price doesn't revert to the old range, $50 or $60. That will become ancient history. Instead, the new range might be $100 to $200 or more, and that becomes the baseline. The analogy I use, look at other commodities. Lead, copper, even beef spent decades in a flat range, then suddenly jumped higher, then stayed within the new higher range. Silver is in that same transition.
You're watching massive stress in London. There are reports that there's genuine stress for silver, lack of silver in China, that the supply chain has completely been dried. For the first time in 50 plus years, central banks not only are buying gold, they're buying silver too. We saw Saudi central bank purchase almost 30 million worth of SLV in August. As much as I almost choke on saying that, SLV, the amount that they bought would allow them to take possession. And then you get reports that foreign investors now hold a higher amount of gold than U.S. treasuries. In fact, the share of U.S. treasuries, they were saying, was down by foreign investors from 49% to 31% today. 49% in 2013 or 2012, somewhere in that neighborhood. But in other words, at the same time all of this stuff is happening, you're beginning to see real stress within the banking system, where we've seen these two big the auto supply and the other company, I think it was called Tricolor subprime auto lender, and you know the private equity in dealing with subprime auto lenders. This company just went belly up and is tied to the regional banks. And so, I think that ultimately the markets will have their way, but again, you have a lot of very big players who are on the wrong side of this, massively short. Bob Coleman was talking the other day of the managed money being short 1 billion ounces of silver, in essence. And that's massive. It's huge. So that means that there are other players on the other side of that would benefit from it. But, when you have that kind of volume on a system that is rehypothecating and trading contracts, where, for example, you look at David Jensen, who's going to come on our show, he talks about 140 million ounce float in London that's trading 600 million ounces a day in deliverable contracts, with as much as 2 billion ounces in contracts out there that could stand for delivery with only 140 million ounce float. Now, what could possibly go wrong? What could possibly go wrong? And maybe that's why Eric Young is saying that the LBMA reached out to China and said, we'll take it at these obscene rates. We need it now. We need it. And we'll pay the high lease rates because of that. Because when you play a game, and look, it's not just silver collapsing. If there was a major delivery failure by one of these banks in London, as an example, all of these banks are not just involved in bullion. They're involved in every single asset that could be traded across the globe. The systemic contagion of this would be catastrophic. It would bring down some of the biggest banks in the world. And this starts to move towards what Tom Luongo talks about, on a coordinated attack against the Bank of England and the European aristocrats. And I don't know that to be true. Tom believes it. But all I can simply tell you is that, to me, the fact that it was done the way that it is done, and then you had someone come in and scoop things up, pushing silver right back up into the positive territory, tells me it was coordinated. It was coordinated by players, perhaps, to drive the paper price down, to accumulate physical at much lower rates to make good on short contracts that were getting very close to, creating this huge squeeze that everyone has been waiting for forever.
When I see reports like this coming out of China, massive quantities of silver leaving exchange warehouses and being rerouted to secondary vaults, I don't see random logistics. I see a nation quietly preparing for something structural. When state-owned enterprises step in during a price pullback to aggressively buy metal on the international market, it tells you they're thinking long-term. They're not playing the price, they're protecting the industrial machine. China's message is clear. Strategic metals will stay home. They're stockpiling, not exporting. And when a country that size decides to hoard instead of sell, it changes the global flow of silver forever. Now, layer on what Eric Young, known online as King Kong, reported: a 150-ton silver lease, almost 5 million ounces, supposedly transferred from the Shanghai metals market to the LME in London. Leased at grotesquely high rates. Think about what that means. When borrowers in London are willing to pay anything to bridge near-term physical shortages, you're witnessing a system under strain. The lease market is like the repo market for precious metals. It's where those short of metal go to borrow. High lease rates mean one thing: desperation for physical supply. So what's really happening? In my view, this is London and the LBMA trying to plug a hole that's finally too big to hide. The West bullion system has always survived on a rotation of paper promises, contracts settled in cash rather than metal, unallocated accounts, swaps, and leases stacked on top of each other like a house of cards. As long as no one actually asked for delivery, the illusion worked. But now, with industrial users, sovereigns, and retail investors all demanding real ounces, the paper game is colliding with the physical world. When that 150-ton lease came through, it likely served two purposes. First, to get real silver into London quickly enough to prevent delivery failure. Second, to knock the price down just long enough for the insiders to buy cheap. Think of it as a coordinated shock and cover. Dump paper contracts into a thinly traded market, trigger algorithmic selling, frighten weak holders, and then quietly use the borrowed metal to refill empty shelves. It's the oldest trick in the book, but it only works when the public still believes the game is fair. And make no mistake, this kind of move screams panic. You don't lease metal at exorbitant rates unless your back's against the wall. You don't transfer silver halfway around the world unless you're worried about a delivery default. The LME and LBMA are supposed to be the deepest, most liquid markets on Earth for these metals. If they're scrambling for supply, it tells you the iceberg beneath the surface is melting. Some analysts dismiss this as noise. Oh, it's just arbitrage, they say. Really, arbitrage doesn't push lease rates to record highs or keep the market in backwardation for 20-plus consecutive days. Backwardation means spot silver trades above futures, a direct signal that people want the metal now rather than promises later. In normal times, futures cost more because they include storage and financing. When the opposite happens, it means trust is eroding. Traders no longer believe they'll actually get delivery months down the road, so they pay a premium for metal today. We've seen backwardation flicker before, but nothing like this duration. For weeks on end, buyers have been saying, "Forget your paper, give me ounces." That's not bearish. It's the most bullish signal imaginable. It's the market screaming that physical silver is scarcer than the paper price suggests. Then you have this bizarre price action. Silver gets slammed down in minutes by waves of futures selling, only to rebound and go green within half an hour. That's not natural trading. That's an orchestrated effort to flush speculators, followed by massive physical buying on the dip. You can almost hear the machinery. The West sells the paper, the East buys the metal. When you see that kind of behavior, you realize this isn't about volatility, it's about control. The West needs to keep the illusion of stability alive. The East is happy to use that illusion to accumulate real wealth. And every time they suppress the price, they give long-term buyers another gift. But here's the twist. If Eric Young's report is right, and Chinese state banks are leasing metal to London, it's not because they want to help. It's a power move. They're essentially saying, we control the spigot. You want silver? You pay our terms. It's leverage, monetary and political. Meanwhile, confidence in Western oversight is collapsing. The CFTC, which is supposed to regulate and protect the integrity of the futures market, has been asleep, or worse. Remember, JP Morgan paid $920 million to the Justice Department for spoofing the metals markets. They were caught manipulating prices through fake orders. That should have been a RICO case, organized crime level. Instead, it was a slap on the wrist. And since then, has anything changed? The manipulation continues because the regulators look the other way. So the public's losing faith, not just in banks, but in every institution connected to the dollar system. The Bureau of Labor Statistics manipulates inflation numbers. The CFTC ignores market rigging. Central banks promise to fight inflation with interest rates that don't even cover the real cost of living. At some point, people stop believing, and when they stop believing, they buy gold and silver. That's why I keep saying, this isn't just a price rally, it's a revaluation of all fiat currencies. Every tick higher in gold and silver is a measure of falling confidence in paper money. The metals aren't going up, currencies are going down. Now think about China's position again. They're not just the biggest importer of silver, they're one of the largest industrial users. Electronics, solar, electric vehicles, all of it depends on silver. So when you read that state-owned enterprises are buying aggressively on every dip, you're seeing a nation insulating itself from Western monetary chaos. They're stockpiling the raw materials for the next century of manufacturing. And notice the language in Chinese state media lately. They talk about strategic resource security. They're blunt about it. They say, we will not allow key mineral resources to flow out of the country. Translation, silver and rare earths stay here. That's not speculation, that's policy. Now imagine the ripple effect of that. If China and other BRICS countries lock down their metals, Western inventories will drain even faster. The LBMA and COMEX rely on continuous inflow from global trade to mask shortages. If that inflow slows, the paper system implodes. That's why you see these emergency leases from Shanghai to London. It's triage. Let me tell you, when a market reaches the stage where desperate players are paying absurd lease rates to borrow metal, it's like a bank paying 50% interest just to stay open overnight. It's a red alert sign of stress. The West is using band-aids to stop arterial bleeding. At the same time, ordinary investors are starting to wake up. The mainstream media tries to distract them with hot takes about stocks or crypto, but underneath, people sense something's off. They see the cost of living rising faster than wages. They see deficits exploding while politicians pretend it's fine. They see central banks flipping from tightening to emergency liquidity within months. That cognitive dissonance pushes people toward tangible assets, land, energy, metals.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.